There was an article in the paper the other day about a report that the bank credit analyst has done describing why they think value investing is going to make a comeback in 2019 after basically a decade of underperforming growth investing strategies, which is the longest period in history of growth outperforming value. And they attribute the change to rising interest rates and what that does to discount rates with respect to growth investors and bringing back value strategies into favor. And our own experience has been that it has been challenging since the financial crisis because we lived in a period of artificial monetary policy, which now seems to be ending with the economies able to stand on their own 2 feet, monetary policy being withdrawn. So it's consistent. Our thinking is consistent with what the article is saying. And while we've had some substantial years during that period of value underperformance, I would say that it's been against a headwind. And I would also say that because often value strategies look at price to cash flow, price to book value, and things like that, you will often see them looking at more substantive companies that have physical assets. And as a result of the overbuilding that took place with the capital that had been available prior to the financial crisis, you ended up with, in this commodity businesses, for instance, you ended up with supply when demand was weak after the financial crisis, when the economy actually did swoon. And what's happened now is that the inevitable kind of rising demand, growth in demand, has continued, and that supply has now been kind of eaten up. And in some cases, the supply was actually not able to perform at nameplate capacity. So you're getting these imbalances again where demand is exceeding supply. And so some of these kind of later stage businesses, cyclical companies, commodity companies, look like they might become interesting over the next period of time. It kind of reminds me of 1987 to 1990 when this very thing happened. It's a volatile ride, but it can be very explosive too. Sometimes share prices doubling, tripling, quadrupling, especially from where they have come from, which was pretty much depression-like conditions. If you ask any kind of portfolio manager over the last few years about investing in basic materials companies or commodities companies, they will say that that's not part of what they do, and they've excluded that. I would expect that when this cycle is done, that they will have been forced to include those types of companies in a large extent into their portfolios, and the top will be in when they do so.